Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
Today we're diving into three major stories. First up, we'll explore how an outdated accounting method used by Walmart and Target is hiding the real impact of tariffs. A trick that can make a 27% margin look like a stellar 47%. Then we'll look at how China's EV giants like BYD are shifting their factory investments overseas to take on Tesla, and we'll dig into why only a quarter of these ambitious projects are actually getting completed. And finally, we'll cover why OpenAI's CEO Sam Altman believes US chip controls on China are failing and how he's reversing OpenAI's strategy to compete, a move that puts him directly at odds with Meta. Let's start with a single fact that might just change your entire perspective on some of America's biggest retailers. When costs from tariffs go up, the profits of these companies can actually, look stronger than they really are. This isn't a market theory. It's the result of an accounting practice called the Retail Inventory Method, or RIM, used by giants like Walmart, Target, and Home Depot. In fact, nearly a quarter of all US retailers use it. So the question is, why would these tech-forward giants use an accounting method that sounds like it was invented alongside the abacus? This isn't just about accounting. It's about what experts call technical debt. Switching from a system like RIM, which is deeply embedded in a company's core infrastructure, to a modern one is an incredibly complex, risky, and expensive process. It's like trying to swap out the engine of a jumbo jet while it's in mid-flight. The risk of system downtime, data migration errors, and massive business disruption is so high that many companies decide it's easier to just live with the old clunky system. The real kicker is this: the method averages costs across huge groups of products, which can hide the immediate financial damage from tariffs. According to Ali Furman, an industry leader at PwC, this can initially overstate profitability. She adds, the more costs retailers absorb, the greater the risk of overstating profitability. Think of it this way. One expert described pricing as a speedboat that can turn quickly, but inventory cost as a massive cruise liner that takes much longer to change course. That delay means it can take 2 to 4 quarters for the true financial picture to catch up with reality, and the rabbit hole goes deeper. In a simplified case study from PwC and CNBC, when a retailer raised prices to cover tariffs and sold fewer items, its real gross margin plummeted to 27%. But under the RIM accounting method, the reported margin held steady at a much healthier 47%. This disconnect has massive ripple effects. For instance, think about the cutting-edge AI and data science these companies use for pricing and supply chain management. These powerful tools rely on surgically precise data to work their magic. But RIM feeds them fuzzy, averaged-out cost data. It's like giving a world-class chef a blurry recipe. The AI can't optimize pricing or forecast demand accurately if it doesn't know the true cost of an individual item, which means data science teams are essentially working with a handicap. This isn't just a technicality. The source material notes Walmart management briefed former President Donald Trump about how this very accounting method could impact its results. This followed a public statement on Truth Social where he suggested Walmart should just eat the tariffs. But that's not the whole picture. This reporting lag isn't always just an unfortunate side effect. Some research suggests that corporations can strategically use this known delay as a tool. It can help manage investor expectations during volatile periods and deflect political pressure over price hikes, giving them a crucial window to adjust their strategy or lobby for policy changes behind the scenes. PwC calls this a clear disconnect between a company's operational execution and its financial reporting. It's a multi-billion-dollar lag between action and consequence. And this has a human cost too. Imagine you're a store or regional manager who works tirelessly to cut costs and improve efficiency. But because of this accounting lag, your successful efforts don't show up in the financial reports for months. Your bonus, your performance review, your team's morale, it's all tied to numbers that don't reflect your reality. This misalignment can be incredibly demotivating and can undermine trust within the company. This all begs the question, when you look at the earnings of these retail titans, are you seeing a true picture of health or an accounting mirage that's about to fade? Speaking of corporate strategies that aren't what they seem on the surface, China's electric car industry is making a move that's turning heads globally. For the first time on record, it's now investing more money building factories overseas than it is at home. After peaking at over $90 billion in announced projects in 2022, domestic manufacturing investment in China's EV sector absolutely cratered, falling to just $15 billion in 2024. So where is all that capital going? It's flooding into a global expansion aimed squarely at competitors like Tesla. The strategy is clear. Faced with brutal price wars in their home market and rising tariffs from regions like the European Union, Chinese automakers are going on offense. Companies like BYD and Great Wall Motor are launching new factories in places like Brazil. And actually, this is more than just dodging taxes. It's a brilliant bit of geopolitical strategy. By building factories in places like Hungary or Brazil, these companies are embedding themselves into local economies. They are securing millions in government grants, tax breaks, and political goodwill. For instance, in Hungary, BYD is getting a substantial government grant to expand its plant. This makes them a local employer and a key part of the industrial fabric, which can help neutralize future trade tensions. They are turning a potential weakness into a major strength. The data shows 74% of this overseas investment is pouring directly into battery factories, the heart of the EV supply chain. They are not just exporting cars anymore, they are exporting the entire factory. Now, a key to China's EV dominance at home is its hyper-efficient co-located supply chain where every part maker is right next door. The big question is, can they replicate this abroad? Interestingly enough, instead of just shipping over all their Chinese suppliers, companies like BYD are actively partnering with local European firms. They're working with Italian auto parts makers and even Austrian steel producers to supply their new factory in Hungary. This is a move to localize their supply chain, reduce costs, and deeply integrate with the European market. This is where the situation takes a more complex turn. A new report reveals a stunning catch. Only 25% of all announced overseas manufacturing projects have actually been completed. That is far below the 45% completion rate for projects back in China, with overseas plans being twice as likely to get cancelled. The reasons for this are a mix of volatile EV markets, where a big customer might back out of a deal, and a simple underestimation of the local challenges. For example, the Chinese battery maker S-Volt had to abandon plans for a major European factory because a key customer project fell through. On top of that, there's a massive culture clash. In Brazil, BYD faced legal action over severe labour violations at a construction site, with authorities finding workers in what they call degrading conditions. This is what happens when the high-intensity, demanding work culture common in China collides with unionized labor and stricter regulations in the West. It's a huge point of friction. This all sets the stage for a massive global showdown. The pressure isn't just coming from foreign regulators. Chinese firms now have to manage Beijing's own growing concerns over technology leakage and industrial hollowing out. And make no mistake, Beijing's anxiety is very real and very specific. The government is terrified of losing control over its crown jewels, proprietary technologies like advanced battery chemistries, unique cell-to-pack manufacturing methods, and autonomous driving software. To stop this, China has started to implement stringent controls, restricting the export of battery technologies and critical minerals, and in some cases, even limiting the movement of its top engineers and equipment. It's a high-stakes effort to keep its technological edge locked down. So the real question is, are these companies escaping a brutal war at home only to walk into a new, more complex battle on the world stage? We were just talking about China's global ambitions in hardware. Now, let's shift our focus to the high-stakes world of AI. The CEO of OpenAI, the company behind ChatGPT, just went on the record with a stunning warning. The US government's strategy to contain China's AI ambitions probably isn't working. Sam Altman's direct words, "I'm worried about China." He says the US is underestimating the seriousness of the competition and that the AI race is far more complex than a simple scoreboard of who's ahead. Altman's concern stems from the fact that China is already excelling in areas we aren't even tracking. For example, China has a massive advantage in what's called inference capacity, basically. Its ability to build data centers and deploy AI in the real world at incredible speed. We're already seeing this play out. Chinese companies are mass-producing AI-powered humanoid robots for factories, and the country now dominates the electric vehicle market, partly by integrating AI into its supply chain. His most explosive claim targets the core of US policy, export controls on vital semiconductor chips. Asked if blocking chips from reaching China was the answer, Altman's blunt assessment was, "My instinct is that doesn't work." He warns that China will simply find workarounds, building its own chip factories or discovering other ways to get the technology. And he's not just guessing. Believe it or not, China is already doing it. While they can't get the most advanced chip-making machines, they are using older DUV lithography to produce capable 7-nanometer chips. More importantly, homegrown companies like Huawei have developed their own AI chips, like the Ascend 910B, which already achieves about 80% of the training efficiency of NVIDIA's older but still powerful A100 chip. They are making up the difference with clever software and by packaging multiple smaller chips together. What really brought this to a head was the next development. The pressure from China has forced a massive history-making strategy shift to OpenAI. The company, long known for its closed proprietary technology, is now releasing its own open weight models for the first time since 2019. So the thing is, this isn't just a random release. These new models are strategically designed to run locally on consumer hardware, not in the cloud. They're optimized for very specific tasks, like helping developers write code. This is a deliberate move to establish a foothold in the world of offline AI development, creating a new ecosystem before a competitor can. Why the sudden reversal? Altman laid it bare. It was clear that if we didn't do it, the world was going to head to be mostly built on Chinese open source models. In other words, OpenAI is fighting fire with fire, opening up its tech to prevent Chinese models from dominating the global developer ecosystem. And this isn't a hypothetical threat. Chinese open source models like DeepSeek and Qwen are already gaining significant traction in developing regions like Southeast Asia. Developers there are choosing them because they are cheap, accessible, and effective. In fact, in 2024, 1/4 of all new AI models in that region were built on Chinese tech. This is the global tide. OpenAI is trying to turn back. This move puts OpenAI on a collision course with its rivals. As OpenAI leans into a more open approach, its competitor Meta, which pioneered open models with Llama, is now signaling it may pull back from that very strategy. The head of America's leading AI lab is publicly doubting US policy and completely reversing his own company's core strategy, all because of the threat from China. This all begs the question, is the US fighting the last war while China is already planning for the next one?
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.